Today I want to zoom in on something specific, because the signal that came through this morning is not just a green light. It's a lesson in how a disciplined system earns its decisions. Good morning, traders. Welcome to the VIXShield Daily Market Summary, morning outlook for Tuesday, April 21st, 2026. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution, signals only. Past performance is not indicative of future results. This morning we are going deep. The entry gate is open, the decision is place, and I want to walk you through exactly what had to be true for that to happen, tier by tier, rule by rule. Because understanding the why is what separates a disciplined trader from someone just following signals blindly. The S&P 500 closed at 7,109. That is a meaningful level, comfortably above 7,100, which has quietly become a line in the sand for short-term directional sentiment. The index slipped a fraction yesterday, down roughly 0.25%, but nothing that signals structural damage. The market is holding altitude. The CBOE Volatility Index, the VIX, closed at 18.91. Yesterday it sat at 18.17. That is a move higher of about 0.74 points, roughly 4% in a single session. Not dramatic, but worth noting. The VIX does not need to spike 40% to matter. A quiet, steady drift higher tells its own story. The 5-day moving average on the VIX cites at 18.21. With spot VIX at 18.91, we are sitting just above that average, not racing away from it, not collapsing through it. The verdict from our VIX trend analysis is neutral, stable. That word, stable, matters more than it sounds on a morning like this. Now, the term structure. The 3-month volatility measure, known as the VXV, sits at 21.24. The VIX, as I said, is at 18.91. That gives us a spread of roughly 2.33 points, with the longer-dated volatility priced higher than near-term volatility. That condition is called contango. Think of it this way. The market is saying near-term calm, longer-term uncertainty. For income traders running iron condors, contango is the favorable environment. It means volatility futures are in carry. The structure is normal, and the conditions that support premium selling are intact. Realized volatility, measured over 10 trading days, sits at 12.81%. Implied volatility, what the VIX is pricing, is nearly 6 points higher. That gap between what the market has actually done and what it fears it might do is the engine that powers premium income strategies. Wide gap, more cushion. That is the environment we are in this morning. On the broader risk picture, the US dollar index was essentially flat overnight, up just a fraction. Bitcoin slipped about 1.5%. Ethereum fell harder, down nearly 5%. When crypto pulls back while equities hold relatively steady, it often reflects a modest risk-off lean in speculative capital without full-blown equity fear. Gold edged up 0.25%, and crude oil, this is notable, fell sharply, down roughly 7.5%. That kind of move in crude does not happen quietly. It speaks to demand concerns, and it is worth watching as a macro signal throughout the session. Let's work through what the headlines are telling us this morning, because context shapes everything. The dominant theme running through today's news is gold, and not in a straightforward way. Morgan Stanley has slashed its gold price forecast from $5,700 to $5,200. That is a significant revision from one of the largest banks on Wall Street. The reasoning ties back to higher interest rates. When rates rise, the opportunity cost of holding a non-yielding asset like gold increases. Money flows toward cash-flowing alternatives instead. And that brings us to the first headline. Higher interest rates are repricing gold stocks and pushing investors toward producers with real cash flow. The cause and effect here is clean. Rate pressure compresses speculative premium in commodities, and capital rotates toward earnings-generating assets. Which brings me to the Equifax headline. Equifax reported a jump in profit, driven by strength in U.S. mortgage activity. That is an interesting data point in a rate-sensitive environment. Mortgage strength typically signals consumer resilience. People are still moving, still borrowing, still engaging with the housing market despite elevated rates. That is a quiet positive for the broader economic picture heading into this session. And behind that, the BlackRock Weekly Market Commentary. BlackRock does not publish these lightly. Their macro view tends to carry institutional weight, and in an environment where rates are front and center, their commentary on risk positioning will be closely read by the desks that move markets. I would treat this as background noise with a volume dial, worth monitoring, not reacting to. Now here is what ties these headlines together. We are in a market where the rate narrative is doing two things simultaneously. It is compressing speculative assets, gold, crypto, while supporting cash flow positive businesses. That is not a chaotic market. That is a repricing market. And repricing markets, while sometimes choppy, are not the same as breakdown markets. For volatility traders, the distinction matters enormously. One more item on the calendar that every trader needs to have circled this week. The confirmation hearing for the Federal Reserve Chair nominee, Kevin Warsh, is upcoming, alongside a speech from Fed Governor Waller. These are the kinds of events that can move the VIX significantly, not because of what is said, but because of what the market interprets. If either event signals a shift in rate trajectory, volatility could reprice quickly. Watch for it. It is the kind of catalyst that turns a quiet week into a memorable one. Now let's look beneath the surface at volatility, because the numbers this morning tell a specific story, and I want to make sure you hear it clearly. The VIX, at 18.91, is sitting in what our system calls the caution zone, between 15 and 20, not in the danger zone above 20, where we would be forced to hold, but not in the clean green zone below 15 either. This is the zone where the rules become your best friend, because the temptation to override them is highest here. It feels manageable. It feels like 18 is not that high. And that feeling is exactly where undisciplined traders get caught. Our expected daily range indicator, the EDR, came in at 1.33%. The gate threshold is 1.5%. We cleared it. The formula is straightforward. VIX must be at or below 20, and the EDR must be below 1.5%. Both conditions were met this morning. The entry gate is open. The EDR Temporal reading, which measures the forward-looking volatility environment over the coming days, sits at 6.16%. That is well above the threshold of 0.94%, which triggers our theta time shift into forward mode. I will come back to that in a moment because it directly affects how we think about time decay and strike selection today. Now, the strategy insight for today. Let's talk about what it means that the decision is place, and more importantly, what the tier structure looks like in this environment. VIX at 18.91, elevated but still below 20. Conservative tier is green, safe to place. Balanced is yellow, tradable but size down if you are cautious. Aggressive is red today, blocked per our VIX rules. We do not push the aggressive button when volatility is running this hot. Here is the micro lesson for today, and it is one worth writing down. When we build iron condors in this system, the strike selection is not arbitrary. On a neutral to cautious day like today, the conservative structure uses wider wings and more distance from the current price. The conservative tier this morning sits at 69.50 on the put side and 72.60 on the call side, giving the S&P 500 roughly 160 points of room on the downside and 150 points of room on the upside from yesterday's close. That distance is not accidental. It is calibrated to the VIX level. Higher VIX means wider expected range, which means strikes must move further out to maintain the same probability of expiring worthless. The net credit on the conservative structure is 65 cents per contract, with a maximum loss of $435. Risk reward of 6.7 to 1. That is the price of caution. Lower credit, more protection. The balanced tier tightens those wings slightly. 69.75 puts, 72.40 calls, and collects $1.10 in credit with a maximum loss of $390. Better credit, tighter cushion. That is why it carries a yellow flag today. Now, the theta time shift. Because the EDR Temporal is running at over 6% against a threshold of under 1%. And because the VIX is above 16, our system signals a forward roll, extending to 7 days to expiration. The reason is Vega capture. When implied volatility is elevated relative to realized volatility, longer-dated options carry more Vega, more sensitivity to volatility changes. By extending to 7 days to expiration rather than shorter durations, we capture between 45 cents and 80 cents per contract in additional Vega premium. That is not a small number when you are sizing positions thoughtfully. All three ALVH protection layers, the short-term spike guard, the medium-term wave shield, and the long-term endurance hedge, are active this morning. The hedge cost runs roughly 1 to 2% of account value annually and historically offsets 30 to 50% of iron Condor losses in a 10% or greater S&P drawdown. The ALVH entry gate is not met today based on premium gauge conditions, meaning we hold the hedge structure as is rather than adding new layers. That is the system working correctly. The discipline lesson today is this: the place signal this morning was earned, not given. Both gates had to clear, VIX below 20, EDR below 1.5%, and they did. But the system did not hand out a full green light across the board. It said conservative, yes. Balanced with caution. Aggressive, no. That graduated response is not a weakness in the methodology. It is the methodology. Markets reward traders who match their aggression to the environment, not traders who treat every day as identical. As you watch today's session, here are your key levels and catalysts. Keep VIX 20 as your line in the sand. If the VIX crosses above 20 during the session, that is your signal to reassess. Watch crude oil. A 7.5% overnight drop does not resolve itself quietly, and energy sector volatility can bleed into broader risk sentiment. And keep one eye on any Fed-related commentary ahead of the Warsh hearing and the Waller speech. Those are the live wires this week. If you found today's summary valuable, share it with a friend. Both of you will receive 14 extra days of free trial access to the full VIXShield podcast and signals. Your personal share link is waiting for you in your member dashboard. This market summary is brought to you by VIXShield, your protection against daily uncertainty. Trade with discipline today. Protect your capital. The rules said place, and that is exactly what the rules are for. We will be back tomorrow at 3:05 Central with the full afternoon summary. Until then, stay measured. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution. Signals only. Past performance is not indicative of future results. This is VIXShield, your daily protection against market uncertainty.